Okay, I have 6:30, so we can start. First things first, I know we haven't met in a
This
while.
meeting is being recorded.
Okay, recording in progress. So we haven't met in a while, and I think Jennifer and I have been probably the only ones here who have been through one of these meetings going through financials. So I am going to ask Ed to, just explain and go through them, go through some concepts after we get started. This is my last meeting. I served 2 terms. I didn't know if I would be even a resident in town at the conclusion of the next term. I just don't think it would be fair to the town that I stay on. So, I'm still interested, but this will be it for me. I think we'll talk about it toward the end of the meeting, but I think you'll need reorganization votes next meeting, and it'll probably be a good idea if Jennifer ran the meeting, since she has probably the most experience, but not necessarily, should she want to be anything, but she's been through this a lot with me. So and I really appreciate her being on the committee. She knows as much or more than anyone I work with on the committee. So I think that's pretty good. So I want to get started. We're reviewing the 6/30 2020 financials, and we're at a good point with the accounting firm Mellinson. We've had a change in the audit team, which we asked for just for a best practice, and so Ed's now our partner here. But you've had a lot of continuation on it. The firm's worked with Wendy for a long time. Since I've been in town, Wendy's been the town accountant, and that's a long time. So Wendy, you've been through, I guess, 4 town administrators, or at least. So, Wendy,
23 years.
Wendy's been a help to me. I've served on different committees, no matter what committee I've been on, and I think the town is very lucky to have Wendy. And hopefully there, at some point in time, there are other people can fill in a gap for what's in Wendy's mind, which is a lot. So I appreciate everything and all your help, Wendy. So I want to go through the financials. I sent an email out to Ed on what I generally want to focus on, but anyone can have questions and go through anything. So Ed, if you want to give a top level before we get into the OPEB and pension liabilities, which I have some questions on, and as well as some other ones. But
Did
anyone
you want to do a screen share at all for anything, or?
Is there any way someone could share? And I'm not good at Zoom. I'm better at Microsoft Teams. If anyone can share the financials and go to the page that they're going to be on, or at least.
Yeah, I could do that.
And also you can go to the, just say what page we are on the PDF as well. So, and why don't you go ahead and go to high level of where we are. My other questions are, and I always ask about, how the town does with respect to other neighboring towns, credit ratings, things like that. But, why don't you do top level and explain info, because so many people are new to going through these types of meetings.
Okay. My pleasure. Thank you, Mr. Chairman, and I'm happy to be here at your last meeting. Hopefully it goes as well as last year. I think everything that you've brought up has really been the hot topics at a lot of these meetings. And just want to say, please, as we go, there are some new faces here. Please feel free to stop me in my tracks. I will leave it to Mr. Chairman if you want to control some of the questions. But look, I'm happy to stop and answer anything as we go through here. And first and foremost, to echo what Len was saying, Wendy, thank you for your help here. And I also just want to thank, other members of the finance team, Adelia, Linda, Marilyn over at the schools. This was a challenging year, but I think that's how a lot of these conversations have started. It was a challenging year, but we had a positive finish. conducting an audit just in under normal circumstances is hard enough, but working remotely and dealing with everything else that came from all angles from COVID really, whether it was professionally or personally, there was just a lot to deal with this year. So I just want to give some kudos there, just because I know it was a challenge here. We did find the books and records to be in good working order. Key accounts were reconciled on a timely basis. There were no disagreements in the application of generally accepted accounting principles. There were no material weaknesses or significant deficiencies in internal control. There were actually no new management letter comments, and I do apologize. I did not get that to you, but I am prepared to speak to some of the action items and some of the things that were on last year, just to give you a status update on where things are. And the good thing is, when we talk about management letters, the eyebrows are always raised when there's lingering comments, but I can tell you that the comments are informational, have been resolved, or they've been mostly resolved. So it's all been really a good approach to that. There's just some other things that I think to really perfect that we can move forward on, but I'd really classify it as some housekeeping things. I really look at the nature of this conversation starting short term and then dealing with some of the long-term aspects. And long-term aspects meaning your net pension liability and your net OPEB liability. And I do think that's going to dominate a lot of the conversation today, as it should. I actually have your credit rating here that does talk about managing and monitoring those liabilities. But before we get into some of those really large numbers and some of the back and forth that's a little bit more complex, it's always better to start with some more of the positive information here. And so looking at things from a short term, any user of the financial statements, but your primary users being your bondholders and your credit rating agencies, they're always going to look at your general fund. Now, that's not to say that there's not a lot going on in the town of Easton, but your general fund is, again, really where that's your main operating fund. That's really where the meat and potatoes of the finances lie. And you're always going to look at your unassigned fund balance. And for FY20, the unassigned fund balance, which, just to maybe draw a parallel here, is for financial reporting purposes, a combination of really your general stabilization fund and largely your free cash. And that ended at $6.5 million, which was a change of roughly a little over $1 million from the prior year. That represents about 8.3% of your budget. That is a significant increase over the prior year, which was $5.4 million, and that represented about 6.7% of your budget. So a good tick upwards there. And the reason why I also want to bring that up is because that is, one of the factors in just looking at the rating agency here is material increase in general fund reserves and liquidity. And when we're having these conversations, I do really like to highlight and take some information from the credit rating, because again, these are your primary users. These are what these are the metrics and the numbers that these folks are looking for. So thank you, Wendy, for pulling that up.
Can you see that?
Yep.
Okay. I have two monitors, so it's hard to know which one is showing.
So it's the third number up from the bottom. Like I said, it's about $6.5 million, and it's about 8.3% of your operating budget. Right above that, you're also going to see some other fund balance classifications. You have your assigned fund balance. That represents your encumbrances and free cash that you voted to use for the next fiscal year. And then your committed fund balance, which I also bring that up because this is another good reserve that the fund has. Your committed fund balance represents your non-lapsing continuing appropriations, which is about $600,000, but there's also a $1.8 million in capital stabilization too. So even though I'm talking about unassigned and how that drives a lot of the rating, I don't think I mentioned this last year, but I do want to point out that there's also a $1.8 million committed fund balance. Why it's committed and versus why the general stabilization is unassigned is there's a specific purpose attached to that amount. So that's really the differentiating factors between those classifications, where your general stabilization, that's really your, I don't like the term rainy day fund, just because I don't think it's necessarily just used for a rainy day, just because I think, reserves should be built up just out of good practice. Now, as far as benchmarks go and as far as metrics, your 8.3% is ticking up towards the, I think I've referenced the 10% benchmark that's typically looked at in the credit rating agencies, as that's kind of a baseline for, certainly your AAA rated communities, but even just a step higher than Easton. So as we talk about comparability, some of the amounts from community to community might seem a little bit larger, but I think you really have to look at it as a percentage of your budget. And that's also in line with what the GFOA, or the Government Finance Officers Association, recommends, is typically, now you have some flexibility, but it's typically 2 months of revenue or 2 months of expenditures. And that's closer to the 16% benchmark. Now, again, if you're going to adhere to that, that's something that's probably going to be seen more in your AAA rated communities, but that's really a policy decision. You really have to balance your core services, managing sometimes the negative publicity of having too much in your reserves. So these are all things that, certainly I understand, but just trying to give you folks some information on what some of the metrics I would say most communities shoot for. It's certainly in the 10% range, or the 2 months worth of expenditures, like the GFOA had stated. Similarly, just as we talk about some of the short-term items, you continued funding stabilization, about $500,000 in the prior year. I think it was about $450,000 this year. Also, you had about $77,000 in interest. So all good things happening really in your general fund. From a budget versus actual standpoint, you had positive operating results, and you also used a little bit less free cash voted for 21. So when we compare that, it's what was voted last year versus what was voted this year. So as of right now, you're able to use a little bit less free cash, and those are really your key drivers in having that unassigned fund balance go up to the tune of about $1 million. Again, a big piece of the credit profile here talks about having a manageable debt burden, and we'll get into that in a minute. But what also is kind of in lockstep with that is the town was able to absorb about 750 or 740,000, in essentially capital outlay in the general fund using either free cash or the property tax levy. That's pretty considerable when you look at a debt burden. And as we move into that, that is mentioned a couple times in your credit opinion. And for your governmental activities, or really your general fund, and actually I believe a little bit in your CPA fund, you pay off 80% of that debt in 10 years. The sweet spot for really all communities is about 75% over 10 years. So you're a step above that. Now, as far as your business type activities go, that's a little bit on the lower side, with 45% paid off in 10 years and 65 over 15 years. But I want to put that in perspective, because you're looking at significant expansion of your sewer capacity. And the one thing that you have in the enterprise fund versus the general fund is you're not necessarily restricted to Prop 2.5, so to speak. And when you look at the sewer fund, you've had betterment revenue coming in, and you've had some other capital contributions that are contributing to making sure that you can pay off that debt service. So I guess really what I want to conclude is, as you try to compare those numbers to that 75% sweet spot, it's not as maybe negative as maybe as I may have implied, just again, because you're given flexibility with your user fees, you've got your betterments coming in, and you've got some capital grants and contributions as well. Wendy, I saw that would you want to say something? You unmuted there?
Oh, no, I just unmuted just in case anything came up. I forgot. But I will say, you're correct though about the sewer enterprise fund. That's still in its early years. The debt is significant with the betterments. We've got the 3 districts now, 5 corners. So that, and water will be increasing in the future when we have the treatment plant and the PFAS filtration systems as well.
Hey, Wendy, why did I guess I'm going to ask why has the unassigned fund balance, or how it's gone up $1 million, which is considerable? Why Was that budgeted to go up by that amount, or was there unforeseen, cash flows or less expenses? I mean, why did that go up so much?
In the general fund?
Yes.
We actually, it really is more expense driven. With COVID, everything kind of came to a standstill, and there was a lot less spending in that last quarter of the year. And so we had a significant amount of budgetary turnbacks. And we also had stimulus money that helped to offset
I was going to ask that. Yeah.
the huge increases in like overtime for like police and fire. So those budgets didn't have to absorb that.
Okay. The stimulus, they're one-time inflows. So, I mean, that 1 million is a nice 1-year hit because, we benefited somewhat from stimulus, correct?
Right. And yeah, that definitely helped. Also with the revenues, we pretty much just like broke even on the revenues. Like we did pretty good in our, some of our like local receipts and things like that, but our like year-end collections, that first, that last end of the year, those collections lagged on, like property taxes and so the overages in the other categories basically made up for that. So we pretty much like broke even in that category. And, we did collect a significant amount of it in the next fiscal year.
This fiscal year that we're in now, that's ending. That's ending in a couple of weeks.
Yeah.
Okay. So that's good news. Okay. Sorry, Ed.
No, you're fine. That's a great question. And it's actually, pardon me, I should have mentioned it earlier. That is pretty consistent with other communities too. I remember looking back in March and, the spending freezes and hiring freezes that a lot of communities were going through. And, I think looking at that last quarter of fiscal 20, a lot of folks really didn't know what to expect, but surprisingly, I think you'd see in many cases that communities were experiencing similar things that Easton did to the points that Wendy brought up.
Okay. I have one more thing. I did want to interrupt one more thing because you did bring it up, which was the town's credit rating.
Mm-hmm.
And I don't remember what it was in the last financials, but it said AA3, AA3. How does that compare to neighboring towns? And did that stay the same, go up or go down from the previous year?
It did stay the same. As far as neighboring communities, pardon me, but do you mind I guess maybe just kind of reaching out as far as who do you see as some of your peer communities?
I don't know. I mean, I'd say, the neighboring towns, Stoughton, Mansfield,
Foxborough.
Yep, Sharon.
Mhm.
Yes, Sharon, like communities.
I'd probably, sorry, Wendy.
Oh, sorry. No, I was gonna say, I did take a look at that. I don't have it up on my screen, but we're either comparable or, I mean, some communities are, might be like one rating above us. In fact, the last time we talked to our, to Moody's, we were asking about, what would it take? They were gonna look into like, what would it take for us to, increase our rating? Basically you're looking at like AA3s or like AA2s. Our rating has been stable at the AA3 for years, I think since maybe early 2000s.
Okay.
I'd say what I was going to say is kind of echoing what Wendy. I'd say you're probably right in the middle. I think you're going to have a handful that are above you, and then a couple that are right below you, or maybe another step there.
Yeah. Or they're the same as us.
Yeah,
All
so
right,
I'd probably say you're right in the middle. And looking back at the rating, as we kind of summarize some of the things that I'm talking about, factors that could lead to an upgrade or a material increase in general fund reserves and liquidity, significant growth in the tax base valuation, large decline in the unfunded pension and OPEB liabilities.
Mm-hmm.
And then pretty much to the opposite, factors that could lead to a downgrade is the deterioration of financial operations and reserves, multi-year decline in the tax base, and material increase to the debt burden and or long-term liabilities. So certainly, I know we've talked about this at length over the last handful of years, but again, kind of highlighting what we're talking about here, the focus is really going to be on your general fund operations and your reserves, but then how are you managing your long-term liabilities? And I do want to stress that, though, is managing the long-term liabilities. They're long-term liabilities and should be looked at in that perspective. What I mean by that is you're not going to solve the sins of the past overnight, but how much attention is it giving? Are you being proactive? And those are some of the metrics that I think certainly in the next, 3 years, if you will, and I'm speculating a little bit, but I call that educated speculation. I think the focus is really going to be how are you managing them? Are you looking at PERAC and some of the advisories that they're putting out and making sure that your inputs and your assumptions and your valuations are staying in line? Because I know they've got more of a presence, I feel like, across the Commonwealth now, really focusing in on discount rates, working with the actuaries and making sure that their mortality tables are up to snuff.
Yes.
So I think PERAC coupled with local action is really going to be helpful in really kind of explaining how you're actively managing these long-term liabilities.
And when you're talking the long-term liabilities, are we talking about the OPEB and the pension, or the other things that are like not off budget, but that we've had borrowings set aside and we tax for, outside of operations?
I would say 95% focused on OPEB, other than just for other, I keep saying OPEB, my apologies, OPEB or other post-employment benefits, which is primarily retiree healthcare.
Yep.
And then the net pension liability.
Yeah, could you for the people new to the meetings, can you explain what those are? And at my first glance going through the financials, I noticed that we had a net decrease in financial position by $10 million, and it was really all to that. And I want to know if it was expected, number one, and number two, what percentage of our operating budget, if there's been a change in the percentage that we now have to set aside to cover current portions of the long-term liabilities.
I'm sorry, if I could, just before you move into that, are we supposed to wait to the end to ask questions? Or
No. I
Okay,
just so you know, whoever runs the meetings, can go through one. I always want people to, if you have a question, just ask. Don't even worry about it. I like to do these informally, and if you wait, sometimes people forget.
Well, yeah, well, that's the thing. We forget, or it gets muddled in the past, and it
please,
anymore,
no, by all means, please ask.
Okay. So if I could just throw out a few questions on what you just spoke about. So you said the biggest problem that our town faces right now, or challenge, I should say, is managing long-term liabilities. So that for me, I've not been on the audit committee. This is my first meeting. However, I was on the finance committee for a number of years, on the select board and on economic development. So I do have I've been working with Wendy for, I think, 6 or 7 years now. I do have a relatively decent idea of what's going on. So the biggest challenge you mentioned was managing long-term liabilities. What are those? So that begs the question, what are the long-term liabilities? What are we doing about them? And then you had mentioned local action. Could you be specific as to what is local action?
Sure. Great questions, and certainly something I figured we would get into as we really talked in the specifics. But thank you for bringing that up. So why don't we start with the net pension liability? So the town is a member of the Bristol County Retirement System, and it represents about an 11% of the multiple employer plan. And essentially, what has happened over the years, and I get it from an accounting perspective, that's kind of where a lot of folks will say, well, it's an accounting number. We fund our pension every year. But from a financial standpoint, what generally accepted accounting principles call for is really the recognition of the cost over the service life of the employee. Now, that's going to change a little bit. It's going to differ a little bit with OPEB, but essentially, you're looking at things on a. It's almost like there's deferred compensation. So you have an employee who's working 30 years, and now when we go back years, when you look at what I think the town and the individual was required to contribute largely was deficient if you were to look at the accrual-based expense. And again, it's from an actuarially determined valuation, so there are estimates. It's not a perfect science, but essentially what the unfunded liability, the story that they're telling is the amount that was funded for those employees, there's a delta and an unfunded aspect of what was put in versus the benefits that were being paid. Now, fortunately in Massachusetts, because all the systems are funded over a certain percentage, it's not likely that they're going to run out of money. But the proper practice is that you should be funding these benefits or that folks are going to be receiving after their tenure with the town. You should be recognizing that related expense in the financial statements as they're earning it, not really recognizing it after they're done providing the service to the town. So and that's where I think a lot of pension reform has come, because you've seen contribution rates go from, I believe it was 5% back in the 70s, you have 7%, 8%, 9%, now 9 plus 2%. And not to mention that funding schedules from PERAC have been evaluated to try to ensure that the liability, so essentially what you're paying now for your current employees, but also in a sense making up for some of the shortfalls in years past, that is, as of today, hopefully going to close. And the Bristol County Retirement System did have a fully funded schedule as of FY 2029 last year. That has since been pushed out to FY 2035. And the reason for that largely is we talked about some of the assumptions and inputs. The discount rate or the expected investment rate of return was dropped from 7.75% to 7.5%. And I believe you've also had some of the mortality tables that have been updated to account for folks living longer. So that was, again, that was the Kentucky Derby version of me kind of giving you
right.
an overview. But is that helpful?
It's very, very helpful. I'm very aware of OPEB and how it works. I guess I should have been more specific. My question is, is that the only long-term liability that you're referring to?
Okay. It would be the net pension liability and then the net OPEB liability.
Okay.
Now, yep.
I didn't know if there was like 6 of them and there was a whole list. One through.
They're killers.
No, I'm very familiar with OPEB.
Okay,
if I didn't know about OPEB, then I should never have been on the finance committee.
Okay.
Now, but okay.
So Ed, you're saying by 2035 is the goal for fully funded?
Yes, that's as of the latest funding schedule that I saw had 2035. And again,
How is that possible?
Yeah, that's what I want to know. It seems to be getting worse.
So
well, last year we put like a minuscule amount into it, given the year, but still. We're
changing of the discount rate has a massive impact. And that's what because it changed so much with OPEB that we reached out to Dan and said, we need to make sure that this change is accurate. And he pointed out, and actually one thing, while we're on this is actually a really good time to do this. Wendy, if you're controlling the document, can you please go to its report page 52? So it's probably going to be PDF page 53, 54, 55, right here. So this is an illustration. One of the things so Gatsby 68 is what essentially is the standard related to the net pension liability. Gatsby 75 is related to the net, Gatsby 74 and 75 relate to the net OPEB liability. But one thing that I wasn't sure why this was done, but lately it's adding a lot of perspective. And so what this is called is a sensitivity analysis, and it shows you if what's going to happen to the net pension liability based on a change in the discount rate. Now, again, this is from one basis point, but you can probably do some back of the napkin math to get additional fluctuations. But you can see 1 percentage point has a really significant increase, and on OPEB, which is going to be on page, it's PDF, pardon me, it's report page 58. So 61 to the previous page. With OPEB, you have two different tables. So you have the sensitivity analysis related to the discount rate, but below that, because of the liability being so impacted by estimates and healthcare costs. So it shows you what's going to happen with a 1% decrease or a 1% increase in the discount rate, but it also gives you, if you look at it separately, if the healthcare costs go up by 1 basis point too, or decrease by 1 basis point, what that could do as well. So you can see that, I don't want to say it's an insignificant change, but even just going down 1 basis point has a significant impact on the liability. Now, OPEB's in a little bit of a different boat, and we talked about local action. On the pension side, it's probably a little bit more challenging because you folks don't have as much control over the Bristol County retirement system. I guess where I would encourage that action to come from is to be mindful of the valuation reports, what goes into them, and monitoring that to understand how that's going to impact the town, because in many cases it's, well, we just get the reports, they tell us what the net pension liability is, and they go on the financial statements, see you later. On OPEB, you do have some control over really how much you're funding. And that was really the significant driver in the increase to that liability, because it went from, so your pension liability went from 40 million to 53.1 million over the prior year, but your net OPEB liability went from 117 million to 164 million. And that's because the discount rate went from 3.75% to 2.5%. And that's to be in line, if you're not funding the trust regularly and the asset balances and at a certain level, you really can't say you're going to invest at 7.75 or 7.5% because you don't have the assets to invest.
Right.
But what the Gatsby did allow, because they wanted to at least set a floor so the liability wouldn't really go crazy, they allow you to utilize the municipal bond index as your discount rate, and that's more closer to the 2.5%. So when we look at addressing OPEB, it's can you fund it, and can you really start putting assets aside, which in turn is going to have a positive impact on the discount rate, which as illustrated here, is going to lower that liability.
Well, the with interest rates going up, intuitively that should drop as well, correct?
That's true. Yep. Everything else being equal, certainly.
I mean, that's happening right now. So,
and I'm not sure what the index is. Oh, sorry.
Okay.
Yeah, I have a quick question, and this might be for Wendy. Where is, I know we don't have a heck of a lot invested in the OPEB liability offset, but where is that? What is that invested in right now? Do we know? Is it in bonds? Is it sitting in a checking account earning 0.25% interest?
It's invested with a company, investment company called Bartholomew Investments. So it's earning more than like our typical general, available cash is. So it's invested in the same way like the stabilization fund is invested, the capital stabilization fund. So it's with Bartholomew, and those earn definitely a better rate of return. I don't have the exact rate, but they do, have a more like diversified investment portfolio, but nothing super risky either, because we're government, we can't do that.
Yeah. Wendy, how are we putting in the same amounts as we have in previous years as our contribution?
For the OPEB trust fund?
Yes.
Yeah, so we're really not able to put a ton of money in. We did put in 25,000 at the town meeting for this year, and we've added a dedicated line, which we also told Moody's, in the employee benefits and insurance budget, to just budget at least 25,000 to just keep at least adding to that trust fund balance. I know it's a drop in the bucket, but
what are other towns doing? I keep getting back to that. It just seems like it is a drop in the bucket.
I would say it's probably more considerable than that.
Yeah. Wow. Okay.
Well,
Mark,
I can't help but think, a few years ago, we set a policy so that reserve funds would be put towards, or a certain amount of free cash would be put towards reserve funds, like 50%. It was percentage based. And we made a policy, and we've really stuck to it for like 7 years. And by sticking to it for that many years, it has put our stabilization funds in great standing. Why don't we have a policy where we set a percentage of reserves, or because $25,000, that is not doing anything. Like, I would actually say it's you could argue, like, don't even waste your time doing that, because it's doing nothing.
Mm-hmm.
I mean, we're talking a lots of millions of dollars. $25,000 is absurd.
Yeah.
So I don't know. A thought to be had for future meetings is to start tackling that seriously.
Yeah, it's tough because it's a balancing act. The budget is a balancing act. One of the reasons that we are a AA3 community and not like a AA2 is because, as we've talked about, every budget cycle is that structural revenue deficit. We need to put a significant amount of our free cash into the operating budget just to balance that. We're also, we're a minimum aid community for Chapter 70. So we only get $30 extra per student. And chapter 90 has been pretty much level funded for, like a decade.
Mm-hmm.
So those are a lot of the challenges that we face. And, we are, like 88% residential. We don't have that diversified tax base. It all goes back to some of the things that we've been starting to do, for long term, but it takes a long time to see the results of that. Is developing the Five Corners area with the sewer to enhance new growth. And
the problem is that if you get that new growth, unfortunately, this is the last place it's going to go, because the political will isn't there to take care of this.
The needs are many.
Doing economically to benefit, whether it's Five Corners, Queesit, or downtown, because those are our 3 districts where we're planning on economic development to, eventually switch the rate and all that good stuff. That's not going to really be meaningful to the town for 20 years. People think it's a switch, and it's not a switch. It's going to take, because we just started taking this, we just actually had the first sewer district go online, 8 years ago, and last year 2 went on. Five Corners and Queesit went on at the same time. So now it's time to build the area. So now we're still 20 years out. So between now and in that next 20 years, we can't keep doing what we're doing regarding OPEB.
Right. So there's basically, there's a couple of things too. One of the things is with respect to the pension liability. So our pension assessment right now is, it's over $4 million. But included in that $4 million is basically the amortization of the pension liability. Now, technically, that is supposed to be fully funded by 2035. Will it really be? It's hard to say, because, pensions are driven by a percentage of your 3 highest years average at a, certain percentage based on your years of service and, you know, your age when you retire. And so that is going to be a driving factor in what pensions are paid. And that's going to probably keep moving that target to some extent. And also, you know, how the investments perform. You know, all of these systems are supposed to be fully funded by 2040. But, you know, who's to say as we approach 2040 that isn't going to get pushed out further? You know, this last actuarial valuation just really moved that. I mean, Bristol County was like 68% funded, and it went down to about 60 because of this valuation. So, you know, if that can be eliminated, then a significant amount of those dollars can go towards funding OPEB. You know, the other thing too is, I know, you know, the town administrator has worked really hard to try to get some provisions in contracts, but it's a provision that it doesn't kick in until every single union, including school unions, agree, is that, you know, employees will contribute like $5 at least a week towards paying the OPEB liability. Now, if we were able to do that with all the employees, that would be a much more significant number to add to this trust fund.
Can I ask a question? I know that when they evaluate your ratings, they look at a number of things, and one of the things they look at is your policies, and you know, your fair policy, positive policies that you have moving forward. If we put a realistic policy in place to actually do something about OPEB, not $25,000 because that's nothing, but a real policy, would they, as they're looking at our ratings, say, hey, they have a policy, this stands the chance to improve our rating, and then we could, you know, erode at that more? Is that possible?
I think it would help. I don't know that it's going to make or break a difference in the rating. I think the bigger issues are the structural revenue deficit, and the fact that, you know, our revenues are they're just not growing at a significant amount, particularly in the state aid category. You know, as we say every year, state aid becomes less and less a piece of the pie because the growth is crippled because we're a minimum aid community.
Can you explain that?
So minimum aid community is, what that means is that for your Chapter 70 school aid that you get from the state, the state comes up with a formula of what they think your budget like should be, a minimum amount, and then they come up with what they think your community can afford to pay. And then they look at basically like the difference, and that's like your state aid. They're saying that we can afford to pay more than what they're already giving us, basically.
And I've been in the town for 25 years. We've always been at that level, correct?
Right. So, but they have this other thing that they call hold harmless aid, so that they're not going to cut your rate if they think that you can pay more, but they're not going to give you a significant amount of an increase either. So all you get is $30 per student, which is, you know, which is crazy.
Yeah. It's
just not enough. It's not sustainable. And I would say about half the communities in the state are minimum aid communities. So it's not like we're one of a handful. There's quite a few communities in that position.
I think another factor in that minimum aid community is that they base it off of the wage rates offered in that community, not taking into account that people work in Boston or Providence or a metropolitan area. Because you look at Easton, you say this is an affluent community. Why is that? It's not because there are jobs that exist in Easton that pay a lot. It's because people work elsewhere and live in Easton. That's
right.
A big factor.
When they develop that minimum budget, you know, that foundation budget, one of the things they do is they multiply cost factors times your enrollment. And then they take that and then they multiply that times, you know, this wage factor. Our wage factor is a factor of 1. We got grouped into the Brockton labor pool, which is a factor of 1. But I mean, Brockton gets, you know, other aid, they're not minimum aid. But if you look at some of the communities surrounding that we neighbor, they're not a 1, you know, and we're in Bristol County too. So you've got all these other communities that border us that aren't necessarily in Bristol County. You got Plymouth County, Norfolk County.
That's a big problem.
And so
Man,
some of them have wage adjustment factors of like, 5%.
Wendy, I
That's
have a question.
significant.
I have a question too. Do the schools get more money if they meet certain demographic qualifications?
Yes.
Yes, they do qualify for more money. Because I know that sometimes I thought we were on the line for sometimes getting money and some years we don't. But I also know from talking to families in town that many families' kids are not marked properly. So I know my own kid, for example, one who is Cape Verdean is marked as Caucasian. And it seems to be a really consistent problem. And so I'm wondering if we even are accurately capturing the demographics of our school and potentially missing out on some money.
I don't think the economically disadvantaged, so there's certain things. There's economically disadvantaged, there's special education. I don't believe that race and ethnicity factor into the formulas. So I think it's things like disability, special education services, economically disadvantaged. Then there's also, we often don't qualify for federal grants like Title I. So, and a lot of grant money, especially even stuff that was dispersed through the CARES Act and other stimulus funding, some of that follows your Title I grant status. So there are some, we received some funds based on just because they were just distributed, per capita. But there were other funds that we weren't eligible for because we don't get Title I funding. And I think that ties back to somehow the census data. The poverty rate is lower than the poverty rate for Title I qualification is significantly lower than our actual free reduced lunch rate. So.
Yeah, our demographics don't help us. Essentially, right? Jen?
Yeah, I mean, honestly, the biggest differentiator between us and say, I always look at Mansfield because they're extremely similar to us in terms of size and demographics. And that wage factor is such a huge driver. They get millions more per year in state funding, several million more.
And that's just the wage factor, Jen?
Yeah. Yeah, so it's the wage factor, but then it also, because there are two numbers basically that work together. So you have, you've got one is the wage factor, and then the other is that they then look at property value and income,
Right,
and earned income, and ours is higher than Mansfield. So we have higher property values, we have higher earned income, which factors into our ability to pay. But then the amount that the state considers your base funding level of need is driven by that salary factor, which we don't get. So they get advantage compared to us on both sides of the equation. Anyway, I know we're way off topic here.
No, that's good to know. I didn't know that. So
Yeah.
Any other questions going back to the kind of the OPEB plan? I wasn't sure if we concluded there. This is all good conversation. I love
yeah,
it.
I mean, it's to me. I mean, I guess I was caught aback by the $10 million change in the budget, and the balance sheet. Excuse me. And I guess it's all just relates to discount rates that we're using. So, but I guess I'm more. I guess the $25,000 amount that we're paying it's just that's a problem that will never fund our share. So
Now, one thing I do want to add, I think everybody knows this, but I do just want to reiterate this just because sometimes it does get lost in translation. When you move money over there, it's not just to sit over there for actuarial valuation purposes. It will come a time, like if you do put considerable money in, this is a trust that you can draw on for these related costs down the road. So I know I'm oversimplifying things, but I feel like sometimes that does get lost. Well, we're just putting money over there, for just to satisfy a valuation, so our financials will look a little bit better. That's not the case. It's similar to the pension fund, where you can utilize those resources to pay for retiree healthcare. And to Mr. Chairman's point earlier, and as we talk about managing the liabilities, and maybe a way to frame this is, think of your pension, and maybe not just your fixed costs, but look at how much of your pension and essentially the health insurance costs, where those have trended, how much of that pie are these costs eating up? How much more are they taking? Is it going from 9% to 12%? And I think that might help shape the rhetoric and maybe the willingness to fund at a more, I don't want to say appropriate level, because I have a hard time saying, you got to fund OPEB, but that's going to keep the town from hiring 2 teachers or, a firefighter or a police officer. I certainly understand that. It can be a hard sell politically. But trying to look at it rather than, I know I'm a CPA, but take the accounting and the accrual basis out of it from a cash flow. What is this doing to the community, and is it having an effect on core services as these costs, continue to grow? And when times are better, can you put more money in? Because then when in times of need, you have this. I'll get in trouble for saying this, but it's almost like a stabilization fund. And again, hopefully it's further down the line, because you don't want to probably be drawing on it regularly with only 150,000 in assets. But just as you try to shape the conversation to short term and long term, and deal with all the other political aspects, it can be a mechanism to utilize when times are tough. So it's not just an accounting device, if you will. It's really trying to address costs that, especially when we're talking about OPEB, because contributions aren't really there, but these benefits are being paid out by the town at a later date, with the retirees contributing, I think, between 25 and 50%. So again, just it can be a resource to utilize.
I mean, to me, that sounds like it's accounting and just moving money over. But I wouldn't think that would take too much political will to get done.
Mm-hmm.
I mean, do you agree?
Some communities are different, honestly.
Yeah.
I think that I would say now that Gatsby 67 and 68 and 74 and 75 have been around since 2015 and 2017 respectively, I think there's been more conversation and understanding of how it impacts the actual dollars.
Yeah.
So I do tend to agree with you, but there are some communities who, I can think of a couple large cities that have nothing.
Okay.
And
it does make me feel better.
It
Honestly, it does, because that was discussed years ago when we started putting money towards this. There are communities that have nothing, and
I audited a community that is, I want to say the liability is probably $650 million.
Yeah, and they don't even have a plan. They're not even talking about how to fix it. They're just letting it hang out.
No, they have nothing. And, I don't know if it goes back to, I did have a conversation with the town administrator in one community, and I don't really know where this came from, but there was some discussion about having reservations on funding OPEB and doing what's best for the community when there was talk. And again, I don't know where this is coming from. I think it was way out in left field that this is something that the state would be willing to take on.
Yeah.
That's like the start of politicizing it, to, be like, hey, you know what? This is going to be your problem. You're trying to pass the buck.
Kicking the can down the road.
Exactly, yeah.
Hey, Wendy, as the finance committee or board of selectmen, do they ever discuss what we're talking about now, or is it just 25,000 and that's it?
I mean, it comes up, when usually, around budget time. It came up when we talked about, it's a small amount. What we're hoping that we will be able to do is over time, just ratchet that up a little bit, year after year to keep building on that.
I will
say, start somewhere.
Point, we do realize it's a token amount,
Yeah.
We completely are aware of that. We know it's not digging us out of anything,
Yeah.
but
Yeah, I mean, my point is, if it's just moving accounts to that, and you can borrow from it or do what you will later on, I mean, what's the view of the harm here?
Later on is like when you're fully funded. You don't want to touch that money until you're at a point where you're fully funded.
I get that, but if you had to, you could. But why not try? You know, that's my point. I mean, you know, you've got a decent amount in the stabilization fund. I mean, if you move that to fund these liabilities a little more than we have, and you can get that back later on, if you had to, then, you know, why not go for something like that? I mean, I'm not saying it's just an accounting gimmick.
I'm sorry.
I don't see.
I want to understand what you're asking. I'm not sure I understand. So are you suggesting that all stabilization funds be moved into?
No, not all. Not all, but some.
Well, we're not even at where we want to be with stabilization. We're still trying to get to a certain point.
I feel like it's a little disingenuous though. Like if you were to move a significant amount in there and then you needed it and you were going to take it out for something else. And I can't even, like, I feel like that would, I don't know, that would really probably.
It seems like we're growing, but we're growing stabilization. I don't think that's a bad thing, but why not grow both and maybe stabilization a little slower? Yeah, that's my point.
I mean, we certainly are trying, but again, there's so many needs in town.
I get it. I get it. I mean, if the goal is to get the stabilization to be at an appropriate level, and that'll drive our credit rating higher, then I can see that's why that's what we're funding, right?
I would love to not have to plug like 50% of the free cash into the operating budget.
I get that as well. Yeah.
You know, so.
Yeah, I mean, you know, it's I don't think this is going to get any easier.
I think that's kind of what I had suggested earlier, where a few years ago we created a policy where a certain amount of free cash went into stabilization, and we were pretty vigilant about adhering to that. If an even smaller amount could go towards this, I mean, obviously we would need the wizards at town hall like Wendy and Connor and team to take a look at it to see if that is possible. But I'm not. I think that's a kind of what you're suggesting, Len.
I am, but you know something, I mean, given, you know, the economic climate right now and inflation going up, you know, town expenses are going to shoot through the roof just to keep up with what we're doing right now. It's not going to happen during the next year. I mean, we'll be lucky to be where we are because, the Prop 2.5, it works, you know, when there's no inflation.
Mm-hmm. I will also say that policy that we created a few years ago is not mandatory. Actually, it's kind of loose. Like we make it I forget what we call it, Wendy. We make it a goal, we make it an aspiration. But if we can't hit it, we can't hit it. Right. But we don't have to stick to it.
No, and that's my point. I don't think you'll even be. I mean, I think during the next year, during an inflationary time, I don't even think, you know. Mm-hmm. I think, you know, you guys are sitting here next year, whoever's at this meeting, and you're looking at a picture which is just not nearly even as good as it is right now, because just to level service, there's no way you can do it on 2.5. It's not going to happen because inflation's going to go, you know, it's what, 6, 7, unless you get more stimulus money, you're going to be in the hole. So I hope I'm wrong. You know?
Mark, I like the idea, and I think, you know, if you take away, and this you know, sits with the select board, I like the idea of working OPEB funding into our long-term financial policy, and you know, let's put a goal, let's put a definition around it. If we can't hit it, we can't hit it, but to at least have it out there, we put some structure and discipline and visibility around something that I feel like is not terribly visible. You know, it doesn't get a lot of chit chat at town meeting and things like that. It's just a line item that we've gone through.
They don't care about it at town meeting because nobody does.
Right.
The people who are looking at it like this, we care about it because we know it's haunting us.
Yeah.
So, all right, I'll start pushing that through.
Hey, Ed, I got a question. It's
Yes.
just a general one, and I don't want to get very political because I don't like to do that in these meetings. Similar towns that allow for sale of cannabis, what is the revenue that we're losing out if you're looking at those in other towns? How much are they bringing in?
It's getting pretty sizable.
Yeah, I just wanted a decent ballpark number.
I'm
I'd
trying
like
to
to know
think.
what we're throwing away because
Well,
people just,
I do recall some of this. So what we would be losing would be upwards of like about $1 million, between, I want to say 500,000 to $1 million a year, depending upon it. However, the House right now, the State House, is talking about removing host agreements. So any benefit of having cannabis in town, it usually comes through a host agreement, and that's going to be off the table. And those communities that made those host agreements, it's going to be gone. But even that aside, I'm still in support of it because it brings in revenue and it's legal and the government taxes it and adults use it.
so we don't get, Mark, so you're saying we wouldn't get the tax. I mean, what is it, like 20%?
You get the tax in the form of property tax,
But you're
and
saying
sales
not,
tax.
we don't get the,
You won't get a host agreement.
okay.
And it's not done. It's not a done deal, but it's very close to, which is really kind of, it's very disappointing.
It's too bad.
It is too bad. But I mean, there are places in town where we could use we could use that to benefit the community.
No, it's just too bad that we're losing, upwards of $1 million a year because,
Don't quote me on that $1 million figure. It's
No,
a lot
okay.
of money.
Mark, I'm not
Yeah.
quoting you. It could be $1 million, it could be 500,000.
That's not out of the realm of what we've seen. I mean, given the number of dispensaries versus how long they've been open, but I mean, you probably looking at, I mean, we're talking hundreds of thousands of dollars, anywhere from 250 to probably upwards to $1 million.
It was a lot.
People are very
put it this way,
passionate in
if
this
that
town
money went
about
towards
it.
OPEB, it would have actually made a difference. Put it that way. No matter what amount it is, it would have made a difference.
And that's what some communities have
Yeah, I don't know.
earmarked those funds for.
I hope people keep bringing
Really?
it up, even if it gets shot down. I just hope people understand the numbers here. And maybe they didn't. Maybe they thought it was a few dollars, right, to keep,
We did bring it up twice though. Like we
Yes.
brought it back.
We brought it back, and it's frustrating because the reason why that article didn't pass is because it required 2/3, not a simple majority. So a lot of people in town said the majority of the people in the town didn't want it. When that's not true, actually, it was just under 2/3 that it didn't pass. So the majority actually did want it. It just wasn't 2/3. So that's why I've had these conversations before, and I said I would be comfortable presenting it again. And when people turn around and say, but the town has said that they don't want it, I would turn around and say, actually, that's not true. The majority of the town does want it.
Yeah. And the thing about these places is they're so controlled with, you got to scan your driver's license on it. I mean, kids aren't getting in these places. There's no freaking way. Excuse me. I didn't, whatever. Anyway, I hope someone brings it up again. So,
Are there other businesses that bring in that kind of revenue to town, or is that pretty much it?
Like that? No, that's it.
We don't have a lot of business in town. That's the problem.
We don't, yeah.
It's a bedroom community. So, I mean, we're living off of really property taxes and what we get from the state.
We had no infrastructure to support economic development in town. We were so far behind the 8 ball. That's why these districts were created, to focus economic drivers in those areas. And that's why I say that's still 20 years away. We just finished the infrastructure. People think that you'd finish the infrastructure, you turn on a switch, business moves in, taxes, the revenue starts pouring in, wait a few years, split the tax rate, everything's great. That takes decades to do, literally decades. Sewer went in Mansfield and Foxborough and all our surrounding communities in the 70s, and they're benefiting from it. We chose not to do that.
And this is not even sewer everywhere. It's just in certain
it's just those districts.
Yeah.
Which.
Yeah. I just wish people in this town had the political will to do things and instead of just complain, but it is what it is. Anyway, Yeah, Ed, I don't know if we interrupted you going through the budget. If you want to wrap up on the management comments, that's fine. We are kind of running a little late here.
No problem. All good conversation. And I think, as we talk about being proactive, I think this is really, good. Again, I think it's been talked about, but it does sound like there's more of a will to, continue the conversation outside of this meeting, in hopes of really, addressing some of these long-term liabilities. So all good conversation, real good questions. My apologies for not providing you folks, something to look at, but I can speak to we did not have any new recommendations. And as I mentioned, we had 7 last year. 2 of the comments were informational. That was preparing for Gatsby 84 and Gatsby 87. Fortunately, given the COVID-19 pandemic, the Gatsby did us a favor and decided to delay these standards for a year. So Gatsby 84 is not going to be applicable until FY21. Gatsby 84 relates to, it's called fiduciary activities, which is going to change how your agency funds, or really amounts that's held for others. So it's amounts that's due to the state, it's some student activity funds. It's really just changing some accounting. So we're working with Wendy on making sure that from a financial statement standpoint, that's going to be taken care of. And really what that's doing is it's potentially reclassifying some things, but it's also adding essentially an income statement approach. Because right now it's just a balance sheet. It's essentially you have cash and amounts held for others. But now Gatsby wants you to show the inflows and the outflows. Gatsby 87 relates to leases. This is falling on the heels of what a lot of commercial entities are doing with FASB, and it's really redefining what a lease is. We used to have operating leases, we used to have capital leases. The accounting treatment was a little bit different. Now it's kind of taken those terms away, and it's really having you evaluate the terms of an agreement and looking at what's called a non-cancelable lease period. That's not going to, it's not, I don't think going to be, Wendy, we've been in talks with this as far as, making sure that really the issue here is identifying, leases as a whole. We have a spreadsheet that we're circulating to all our clients to track all the required components, but also just be mindful of some of those other leases where the town might be a lessor, where it's lease land, lease buildings, things like that potentially might fall under the umbrella. But for a number of communities, it's not going to be a massive impact. Really where the issue is from an audit standpoint is completeness. Is how do we know we've captured everything? But we have we'll call it a housing document that we've been working with our clients to make sure we capture all that data. So just to conclude, really informational, we're going to be good to go on that front. We had 2 comments that were fully resolved. One was evaluating the indirect cost allocation. And really what that was is the water fund essentially subsidizes subsidizes a poor term. Costs in the general fund are shared costs that are attributable to the water fund. So what the town has put together is a methodology on how that's calculated. And it hadn't been updated for a number of years. But that was corrected in FY 2020, where the amounts that were going into those shared costs were updated to more current actual figures. The other comment was establishing a credit card use policy and procedures. That was actually done shortly after this meeting last year. I think we had them by August 2020. So that comment has also gone away. We had 3 other comments that I'll call partially resolved, and I think I said at the beginning of the meeting, there's just a couple of housekeeping things to really get everything up to snuff. And the first one was preparing for single audit changes. And what happened a couple of years ago is uniform guidance came out, and that really kind of encompasses what used to be A133. And so as it relates to your federal awards, both town and school, so essentially this single audit act is applicable when a community spends more than $750,000 in federal awards in the year. You have to have what's called a single audit or program specific audit. The town has had one pretty much every single year. But one of the new criteria that is in uniform guidance is it explicitly states that you must have written policies and procedures over certain elements. Now, that's not to say that there are no internal controls and there are no procedures related to these certain areas. It's procurement, subrecipient monitoring, allowable and disallowable costs. Procedures are in place and these elements are being considered, but it's really just standardizing a document for both the town and school and their administration of these federal awards to make sure that it's really checking the box in these key areas. We've pulled together some templates. They need to just be refined a little bit because some of them are more geared towards larger cities and other things that may not be applicable to the town. But we're at the level as we go through the single audit where that's largely going to be complete. We've got the bones and the structure. It's really just refining it to be more town specific as opposed to just kind of generic language. So we've shared that with Wendy, and we're going to get Marilyn's input too, just given how significant the school component is to the federal world. I mean, that's really probably where most of the money's at. So again, I really just want to clarify that it's not saying that anything is not in line with expected internal controls. It's just not written down. So that is in process, and we're really just making sure that the language adheres to all the requirements and is tailored towards the town. The next comment was improving timeliness of the trust fund transfers, and this largely related to the OPEB trust fund. And as we talked about that $25,000 contribution being made last year, in the general ledger, it was properly recorded, but it was not moved from the bank, from the operating bank to the actual OPEB trust. It was subsequently corrected in FY20. That was all set. But where the last remaining piece is hanging out is the June interest, I believe, wasn't booked until July. So why this becomes an issue is depending on the actuary that you're working with. If you send them the bank statement or if you send them the general ledger, they're potentially looking at two different numbers. So it's imperative that those numbers agree so that the asset balance that is being factored into the valuation reconciles to both the bank statement and the general ledger. So the last piece is just making sure that June, and again, this happens everywhere. We're really trying to harp on our clients to really pay attention to that last month, make sure that you're recording it in June. And again, it's not just your interest, it's your unrealized and realized gains that I think are really driving that. So again, I think it's just it's a very small step that should be fixed as of 6/30/2021 in come 8 days from now. And lastly, and this comment has been in the management letter for a couple of years now, and I do want to really commend Wendy and Adelia for really trying to address this, is making sure that the ambulance related activity in the general ledger is reconciling what's provided with the third party. And they took tremendous steps this year to really iron that out. And it becomes really challenging because what the third party provides, two things. There's timing issues between the activity that they have and when it actually hits the town, meaning they might say, well, we paid you $50,000 in January, but in reality, the town got, $47,000 and I can't remember what month I said, but crossing periods. So it really does create, it can be a headache. And it's not a town of Easton thing. It's just, it can be a very tedious process, as much as having a third party does really help because it takes away some of the other challenging parts of the process as far as billing, collecting, and dealing with, going after the insurance carriers. It can create some accounting challenges, but significant improvements were made. But, we found out that some of the reports that were being provided were not all inclusive. So that's really the next step, is just making sure that all the information that is necessary to true up the activity is being provided. But so again, I consider these partially resolved, but I really look at them as housekeeping items. So what I'm happy to say is that, 2 informational comments, 2 were resolved, and there's really 3 other items that when we're sitting here next year are likely going to be resolved.
Okay, and there's no material
Nope.
issues with any controls in the town at all?
That is correct.
Okay, great. So
The-
no,
Sorry, the
No, I
issue
was
with
gonna-
the ambulance receivables too is that there's just such a large volume of
Yeah.
transactions.
I
Which is
get it.
why it's difficult, you know, you get money coming in from like Medicare, and you know, you got to figure out if it's from a deposit that they're saying came in that particular month. It could have been from the previous month, and so it really, there is a large volume of just transactions that occur each month.
But it's not a
difficult.
material weakness of controls, correct? Ed?
No, it's just we see this in a lot of communities, and
Okay.
so even some of the variances that we talk about, it's really inconsequential, but I've seen it spiral out of control, particularly quickly when there's turnover.
Mhm.
And so anytime that there's room for improvement, I certainly want to emphasize that. Speaking frankly, I don't look at it as a big deal, but I do think it's just one thing to focus on. I think things could be trued up a little bit better. So really just emphasizing that it's not uncommon when you have these third-party providers, but you know, pardon me for thinking this way, but I've seen it go south, and you were just trying to really guard against that is the reason to focus on this, where again, some of the differences we're talking about are trivial.
Thanks. All right. Ed, I appreciate you joining us tonight, and you know, especially after we had to cancel last week. You know, I'd like to move ahead with the agenda. If anyone has any last questions for Ed, please ask now. You know, I'm hoping, you know, that you know, when we address whoever does it addresses the Board of Selectmen, that someone can provide a good summary of what we discussed tonight. So, but it was a good discussion again, Ed. Thank you again.
My pleasure. Thank you all for having me.
Yeah, and thank the others at your firm on your team who helped you as well. Thanks.
Will do.
Okay.
Thanks,
Thanks,
everyone.
Ed.
All right. All right.
You want
Do
me
we
to jump
have,
off? Or-
oh, sorry. I was going to say, do we have minutes to approve tonight, Wendy?
Yeah. No, actually, don't think I have that.
I didn't think so. Okay.
I know Roseanne was gonna do them. I think sometimes it's hard to find the meetings on.
I think what we did last time, and it's a while ago, is we just did a quick meeting just to approve minutes. So if we did have to approve one, it would be like a 5-minute call where we just did that, and it wasn't necessarily a bad thing. If you have a quick meeting, just to meet right after that meeting, type out minutes and approve them. But
Okay, but we can do that too at the net, because we're gonna have to reorganize. So
yeah, so that's what I was going to talk
tackle it
about.
then.
So yeah, so the next meeting I'll be replaced. I think I'm the only spot that's up. So someone will join the committee, and you guys should vote to reorganize. And generally, I think it's good to someone who's not from one of the departments representative. That person would be great if they could serve in the chair role. But Jennifer's been through the meetings before, so she can help whatever. I know at one point, Jen, you were like I am, not in a committee, but now you are. So that's up to you. So, but I don't know what you guys want to discuss at the next meeting, but anyone who wants to bring something up, that's fine. I do think Wendy, you should schedule something before the board. And
yes, yeah, the board, town administrator was asking about that too.
Yep. So what I would do is reorganize fairly quickly after June 30th, have a quick meeting, and then discuss what you'll do for the board and who will do it. And maybe I'll even tune in. So I just want to thank everybody, and especially you, Wendy. So if anyone else has anything, if you guys want to schedule the meeting now, if you guys want to come up with the time, that's always good to do.
Our meetings usually on Tuesdays this time. I mean, what is the standard time for audit meeting?
So, Mark, just so you know, so my first 2 years, we probably met, I would say 4 or 5 times, and that's because we were dealing with the town
Yeah.
audit.
Yeah.
It was the town
Operational
audit.
Yeah.
Yep.
But after that, I mean, now I think you just need to meet 2 or 3 times. I mean, basically just
Okay.
discuss financials or any other thing that's coming up. So, I think what you should do is just find a time. It doesn't have to be a certain night of the week. I mean, I always thought it was
So
best.
infrequent that it doesn't work that way. I got you.
Yeah, I mean, I always try to hold meetings when everyone could go. Now this month we're running out of time, so I just said, look, I wanted to meet before the reorganization, because I just didn't think it'd be right to go past the year and throw this on a reorganized committee. So I just wanted to get a quorum. But generally, I think it's a good idea to try to get everyone, just considering how the infrequency of the meetings to meet, and and you've seen how, the good thing is everyone's seen the blood and guts of what goes on. So, that's basically it. I think you should do, at least a mid-year update. So, 2 or 3 times, but you will need a meeting for a reorganization fairly quickly, and then vote on the financials that were presented, that the committee backs these, or which I assume it does. And just reorganize, and that's basically it, and talk about what you'll talk about before the board, and maybe 1 or 2 people can go. And I missed the last one. I was on vacation, so I think Jen, I believe you did that, right?
Yep. Yeah, I'd be happy to present again, or to lead the charge if somebody wants to join.
Sure. All right, so if you guys want to plan your meeting now, that's fine. I mean, I'm since I won't be there, I just if you guys want to come up with time, or just do that through emails, that's fine as well. So
When do we expect, Mark, do you know when we would expect Len's replacement to be appointed?
We just did the open, probably mid-July. Yeah, mid-July at the earliest. So we actually, if we're going to wait, and there was no applications as of last night. There was no applications. So I would give it a couple weeks to see if we can get an application or 2 in there, and then appoint that person, and then have a restructuring. And
Mark,
then, yes.
Mark, I didn't know that. I'd be happy to stick around if
That's up to you.
I mean, I not for 2 years, but if you want to do temporary until you can fill it, I'd be happy to do that. Because my big thing is, I won't be here. I don't anticipate being physically available, and we will be meeting physically probably from November through May. So, but at least through October, or at least mid-October,
Yeah,
I'd be happy to stay on.
If you could, that would be great. You just have to go through the proper channels to make that application.
Right.
And we're able to still meet via Zoom despite being past the state of emergency for, like, Wendy, I want to say like the next year.
April.
Isn't it
Yeah.
April?
It's a
April.
long time. So long as you're a resident in Easton and you have a phone,
I'm still gonna be a
you'll always
resident.
be able to participate. And if you find yourself not being a resident, just resign.
Okay. All right. So, Wendy, if you can let me know what I need to do, or inform the board that until they get a volunteer, I'm happy to, be temporary for a year. But I'm going to defer on the chair role. That's it's fun, and I'd rather defer on that. So, but I'm happy to stay on.
I think we should wait until the next select board meeting and then throw out an email, because I'm hoping that Len will have made an application, and by that meeting we can appoint him, if the board decides to do so, and then we can go to a reorg right after that.
When's the board meeting next?
So I have, I pulled up the schedule. So the July 12th and the July 26th are the July meetings.
So, I mean, I can't do anything. I'm officially off the committee as of June 30th is the problem. So, because they would need to reappoint. I don't even know if they could do a temporary.
Yeah, and that won't. So you'll be off the committee in 8 days, and then you'll just be reappointed.
Okay.
So yes, I don't, there's no concern.
Yeah,
I don't
I
have
just don't want to, be appointed to a 2-year term. And I'll tell you right now that I probably would only, serve one year, and
Mhm.
maybe the board wouldn't mind. I just don't want, I don't like when people say that. And
I
I'm not
get you.
I'm not a big fan of people going for appointments and then quitting early. And I would
Mhm.
never do that. So,
Well, how about this? Don't make that decision right now. I mean, think about it.
yeah. Okay.
Yeah.
But, I'm always happy to help the town. So, you'll say, you can talk to the board, and we'll, let me know what I need to do. If I
Okay.
need to do an application between now and then, I'll do it. But,
Okay.
they should always keep looking for someone full.
Yeah, definitely.
But
Well,
you need
you like to, of course, you like to have it contested anyway, right? So
Yeah.
yeah.
My appointment was, just so you know, my original appointment was 3-2 vote.
Wow, that. Oh yeah, that was a very active time in Easton.
Yes.
I won't get into it.
No, I remember. So I would say let's table the conversation of when do we meet next. I mean, we can't have that
All
conversation.
right, so Wendy, I'll if you could get me something I need to complete. If it's I don't remember,
Yep.
it's an application. If you could send that to me, I'll send it
Okay.
back in. And Mark, if you could get that on the agenda, we can go forward with that.
Okay.
Yeah, I can work on getting that on the agenda.
All
Awesome.
right,
Thank
that's
you, Wendy.
fine.
Yeah.
But still a reorganization next meeting, and someone's gonna I'm just gonna be the second, on of the non-committee people. So
What I would think we should probably do then is look at seeing about getting you reappointed for at the July 12th meeting. Then we could meet and reorganize in between July 12th and then target maybe the July 26th select board meeting to do the presentation.
sounds fair enough. Actually, not July 26th is not fair enough. I will be where I'm going to be from November to May. So the week after, the 2 weeks after that, we could do in August. Because I would like
August 9th?
Yeah, if they could. Because I bet you that's the same week they did it last year. Because I was away that.
Yeah, it was the 10th, I believe.
Yeah. So let's do that then. Let's ask if we can do the presentation in August.
Okay.
See that I thought I was done, and you wrote me back in. Like,
I do.
I feel like Al Pacino,
Yeah.
So is there?
So Len, you're out just in terms of kind of keeping some possible dates in mind for us to meet between July 12th and
I'm here the 12th. I'm out. I'm away July 23rd through the 28th. Those are the days I'm away.
Okay.
Any other day is fine.
Okay.
I'm assuming that the board will appoint me on the 12th. I go into town hall on the 13th.
Does anybody else have time off coming up, July and early August, that we need to be mindful of in terms of getting this group back together?
For appointment? I mean, for to
reorg and to talk about what to present. Yeah.
I'm open for anything. I mean, yeah. I honestly don't know until an email goes out with a few dates. That's just my life is like that right now.
Okay, so you don't have like a week blocked off where you'll be off the grid.
Like if you ask me right now what I'm doing tomorrow, I don't know. If you ask me right now what I'm doing in 3 weeks, still don't know.
Yeah.
You're going.
But I know it's something.
You're going to Canopy tomorrow, just so you know.
This is true.
I'm glad it's open. All right, so I'll bring up the motion to adjourn, and next meeting we'll do minutes and reorganize.
Second.
Excuse me. All in favor? Aye.
Aye.
Okay, unanimous. We'll see you
Oh, we're
guys.
supposed to take a roll call? Shoot, I forgot.
I think we are. Did we do the emergency order?
I never
at the
do
beginning
that.
to open?
I don't think I've ever done the roll.
I was supposed to say.
Yeah, I'll start the roll call. Lamb, yes.
All right.
Hey, Lamb, yes.
Star, yes.
Berkowitz, yes.
Elia, yes.
Okay.
Yeah.
5-0. Looks like we're adjourned. And I guess I
night.
will be seeing you all at our next meeting. Thanks,
Thank you.
everybody.
I enjoyed.
Okay. Thanks, everyone. Bye-bye.
Thanks, everyone.